Markets, you only live once. Do you go all out today? What do you think?
So, God, that phrase game changer, I struggle to use that. I know strategists tend to use it fairly frequently. But having said that, though, inflation is the critical variable for the markets. I mean, we look at everything through the lens of how does it impact inflation, even the employment report. So it was big. It's important. It was. Obviously, directionally, it's moving in the right direction at an accelerated pace. Some base effects things going on, but the internals all point towards that. So, yeah, it's good news. We've moved beyond that sort of crises mentality around inflation. Maybe we're a little bit in the chronic stage that from here on out, it's a little bit more heavy lifting. Fed is most likely going to tighten 25 in a couple of weeks here, but I suspect after that they should be on pause, and I suspect the rhetoric coming from the Fed post FOMC should be a lot less hawkish.
Yvonne? Okay, now let me take that. Let me take the Jack. Okay, apologies then.
I left you speechless.
Go ahead, Dave. Go ahead.
Yeah, I know. I mean, I have so much questions to ask you because it's almost cross-asset right now. I know you've been long treasuries. Yeah. Does the print overnight change in any way where you want to be more, as far as the curve is concerned at this point? Is almost a long treasuries call just about across the board?
Yeah, you're right. It's no longer just, hey, do you want to be long duration in treasuries? It's where in the curve do you want that duration coming from? And you want to be kind of moving down the curve a little bit. It's interesting going into that CPI report, the hedge fund community, the leverage crowd had record net short positions in the front end, the shorter dated futures, 2 years, 5 years. So they were not positioned for that. So I suspect you'll see position unwinding, which should lead to a steeper curve. Again, let's go back to the Fed for 1 second, because this is not going to get the Fed to start cutting rates. All this does is get the Fed to probably pause for an extended period, keep rates elevated. We need to see weakness in the labor market before they start cutting rates. So that would be when you really start to see some significant curve steepening.
Are you seeing, the risk reward in terms of, I think it seems like most people are still thinking fixed income is very much an important part of portfolios this year. What part of the curve do you think still has the best risk reward?
So, Yvonne, I've had this mindset. So I came into this year saying, hey, it's going to be the year of the bond. I still think that could be the case, but I'm probably a little bit more open to the idea it's going to be the year of the coupon, meaning that hey, it could be the bonds stay in a range here. You just earn the coupon. But given last year's sell-off, the backup in yield, that earning a coupon is not a bad thing as opposed to over the last 10 years. So, we've got exposure via mortgages that really on an effective duration basis are that sort of 7 to 10 year part of the curve. We've got treasuries in the 10-year part of the curve. I think that should do very well relative to other parts of the curve.